Give me positives and negatives to owning storage in California.
We think California is one of the best self-storage investment markets in the country. We feel that the supply-demand dynamics and a strong demographic base set California up to be pretty favorable investing landscape, especially from a self-storage standpoint.
I'd like to welcome everybody to Buchanan's County Capital Podcast. I'm Robert Brunswick, Chairman of Buchanan Street Partners, and today it's my great pleasure to have joining me Charles Byerly and Feerooz Yacoobi as my guests as we discuss everything you might want to know about the self-storage business. Amazing asset class, and I think you'll enjoy our expert input today. So Charles is the President and CEO of U.S. Storage Centers and Westport, a real estate investment company that today oversees over 20 million square feet of retail, office, but yet primarily self-storage. So that's really what we're going to lean in today in really 12 U.S. states. Our relationship with Charles is based upon their company managing a lot of our self-storage assets. So he clearly knows what Buchanan's involved with, so can help us better understand that from his seat. And then my partner, Feerooz Yacoobi, he's Buchanan's Senior Vice President in charge of all of our investments in storage acquisition and development. Today we oversee about and control about 11 storage properties, 11,000 units. So a growing portfolio under Feerooz's leadership. So guys, let's get started as we share your smarts and the market and the industry knowledge for our listenership within the storage space. So we'll go back and forth a little bit. And I'm going to use you, Charles, to kind of kick us off with describing, just for everybody's kind of frame of reference, Westport and U.S. Storage Centers. What's the business model for the listenership?
Yes, Robert, first of all, thank you for having me. This is very exciting. Happy to be a participant on it. So again, thanks for including me. My name is Charles Byerly, President and CEO of Westport Properties. We have three verticals that we focus on, Robert. The main one that we've been in business with for a long time is the self-storage vertical, fully integrated from kind of the soup to nuts, if you will, just from we build, we acquire, and then we operate, and we do all of our own financing unless something complicated happens, which then we'll call you guys or we'll call another friend down the street to help us out. But generally speaking, we try to do everything else in-house, including all of our marketing and whatnot. We're also in the multifamily arena as well as the industrial arena. Those are much smaller pieces. We're fairly new to both of those spaces, but we continue to be active in both spaces and hope to grow those.
So just for clarity, how many separate standalone self-storage properties do you manage/own?
Approximately 230 assets in 20 plus states.
Okay, amazing. So great expert and perspective for all of us. And then Feerooz, what is Buchanan's self-storage platform today? You might even include our lending vertical that we have also.
Yeah, so Buchanan has a long history, obviously, in self-storage, primarily on the debt side of things. You look at our business today, in addition to being a construction and bridge lender on balance sheet to other owners, we're actively deploying equity ourselves and have become owners in the asset type in the sector. So my team, we're actively acquiring and developing, working to build an institutional quality portfolio throughout the western states, really with an emphasis here in our backyard of California.
Great. All right. Well, I think we've got a wide range of conversancy within our audience today about what storage is, what it is, and how it's really evolved from its infancy. So, Charles, I'm going to kick this off with you. Could you describe today the greater self-storage industry and who uses storage predominantly, the range of users, to help us understand?
Yeah, for sure. I think going to the macro, kind of the first question, self-storage has really evolved, especially as an asset class. I think it's become more of an institutional grade asset. It's not part of the core four, as we know, but what I would say is, as we probably all have been seeing lately, in terms of where institutions are putting their money, it's less in the core real estate and it's more in alternative asset classes. And we've been one that's been highly sought after in recent years. just as kind of things have changed through the pandemic and whatnot. So it's definitely one that becomes or that's becoming even more and more, I would say, popular, especially amongst Odyssey funds. There's a smaller percentage of Odyssey funds that invest today, but that number continues to climb, and more players are coming into the space looking for an operating partner or a developer to team up with to try to fill that void that they have.
So I want to dumb this down a little bit, and not that we have an inexperienced listenership, but I want to make sure they're getting it. Odyssey, that's an institutional benchmark for institutions to
Right.
kind of grade, and is that correct?
That's correct. Yep.
Okay.
And so, yeah.
And and then the user of storage today, to be clear, give us a range of the typical user of storage.
Right. It's always been known for its life events. So anybody that's going through a life event, there's lots of those. You could say maybe there's a disaster similar to the fires or floods. Maybe there's a divorce. Maybe there's a death in the family. Maybe there's a good thing. Maybe they're remodeling a kitchen or a bedroom or doing an add-on. So those are folks that will use our storage, and ones that are mostly well known for that. We also have a lot of small business owners that use self-storage. So think of like subcontractors, plumbers, et cetera, that need places. They're not big enough for an industrial building, but they need kind of like an incubator type of space. So they'll use larger self-storage units to put inventory in and supplies and whatnot.
And just quickly, the average tenant stays how long in a storage unit?
It's interesting. That's calculated a bunch of different ways, but what I would tell you is the way that we calculate it. We look at our move outs on a regular basis, and based on who moves out, we drop the shortest 10% of the tenants and the longest 10% of the tenants, and we use that 80% in the middle to say, hey, what's that length of stay? And that's probably gone up recently, but it's averaged anywhere between 10 to 12 months over the last several years.
Helpful. So not too dissimilar to multifamily, maybe even a little longer typical stay than multifamily in apartments.
Right. And some will tell you, like some other experts will tell you that their length of stay is longer, and it's just depending on what they put into that equation or not. So some will quote a couple or a few months longer.
So Feerooz, you said that you guys are building from the ground up. You're buying existing property that's not leased but finished, so you're taking the lease up risk. You're buying stable storage that's built and leased. So quite a range of diversity in your portfolio. How are you capitalizing these transactions? It seems like kind of a myriad of risk profiles.
Yeah, so I'd say as a levered buyer and investor, we're utilizing both debt and equity to finance transactions. I think we've been fortunate to have a handful of great lending relationships, primarily from regional banks and life insurance companies that help us finance a lot of these assets that we're buying. All of our capital on the equity side to date has been a diverse mix of family office, high net worth, and RIA capital.
Feerooz, continuing, tell me a little bit about, as you see it from your seat as our portfolio manager of storage, what is the appeal to invest in storage for a typical investor? Why do they want to have that as an asset class?
Yeah, well, I think if you look at storage historically, it has a tremendous track record of success, especially against the four major real estate groups Charles mentioned. It's historically outperformed over extended durations of time. I think part of that is that self-storage is a need-based product offering, and it's become known to be really recession resilient and less correlated with the overall economy. So I think investors have really appreciated the predictability of cash flows that the asset type has to offer. And in regards to the Odyssey funds and what Charles was referencing, we're definitely seeing storage not be the small niche asset type anymore. It's really becoming a superior component of a diversified real estate portfolio amongst investors.
Feerooz, great summary on kind of the why investors like storage. Makes sense. Let's further that, Charles, as a thought leader. I know as Westport is. So when I got in the business, there were four food groups: retail, office, industrial, and multifamily. Today, there's 25 asset classes and subsets of those asset classes that you can participate now in customizing a real estate portfolio. So why storage, and why have institutions really flown to it in such a significant way to make it one of the more core assets within a real estate portfolio?
Yeah, well, I think I think that's a great question, but it's interesting because obviously it was slow to catch on for a while. It was very hard to finance. Obviously, that would then layer into cap rates being higher. So it took a while for that to kind of come down. And as they've come down, what investors have realized is that the product type does good, as Feerooz mentioned, in an economy that's going up or an economy that's going down. There's really good sticky tenants that stay in either case. The other thing that I would say is that when you look at the makeup of a self storage facility, generally it's 500 to 1,000 units, um, and those units, I mean, they're all different uh, clientele. They're all different tenants, right? So when you compare that to a single uh, tenant industrial deal, or you compare it to even a multi-tenant industrial deal, or a hotel, or a small retail center or whatnot, you have tenants that are unsophisticated, relatively speaking, to other tenant types that don't talk to each other. So no one knows what they're paying in rent. They don't know. They're not sitting there talking to their neighbor like in an apartment building, as an example. And so you have a really interesting way to kind of manage revenue. And then I would add also that you have the ability to, because of the length of the leases, which are month long leases, you have the ability to really play with that rental rate, the revenue management side of the equation, much better than in other product types. And then lastly, I would just say you're not dealing with necessarily a tenant as someone that's living there, as an example. It's their stuff, which is meaningful to them, but your laws in terms of what you have um, as a as an owner are a little less stringent than, say, with the multifamily side of things. Lastly, I'll say that you look at tenant improvements and leasing commissions. We don't have those in storage, whereas other product types are having to deal with those. So I would say for those three or four reasons, those are things that have really allowed storage to, over the years, do what Farouk said, which is to outperform all the other product types. Over time, as the industry has gotten more sophisticated, we've gotten smarter about how to operate and really maximize the bottom line.
Well, you guys are providing a great foundation for the asset class, and well, let's continue through here. And I think with those flows of capital that you alluded to, as storage has been validated within the institutional market, which, by the way, provides more liquidity and predictability of capital flows, which is another variable for its performance. How would you, Ferouz, look at kind of the overall outlook for storage in 25? I assume with all that money that Charles shared that's been flowing, there's been a bunch of building. So I don't know if we're overbuilt as a asset class or not, but color for us a little bit about going forward this year, how you see it.
Yeah, I think at least the first half of 25 will be a lot of the same as we saw in 24, which unfortunately, from the demand side of things, was pretty sluggish, just given the stalled housing market. And we can get into that a little bit more later. But it's going to be a competitive leasing environment. I think we will start to see some legacy projects start being delivered in many markets here in 25. But then I think, and I'm hopeful for a little more of a bullish outlook towards the end of the year as we enter 26, and people begin moving again, and we see an uptick in the residential housing market. So really, I mean, over the past 24 months, we've been fighting this demand side of the equation. And in reality, it's just going to take some time to work its way through. We're really dependent on the housing market and housing affordability with interest rates. So that's probably going to be more of a 26 phenomenon than it is a 25. But hopefully, we think we start seeing consumer demand stabilize towards the end of the year.
Charles Ferouz talked about correlations with housing. So as I think about all of the asset classes within real estate, they all have their correlations to something. We certainly learned that within the office sector. Um, so talk a little bit about why is you talked about life events were the primary determinants of storage's growth and why people move and need storage. But there seems to be a predominant correlation to housing starts. And so color that a little bit if you could for our listenership.
Yeah, absolutely. I mean, at any given time, mobility is 40 to 50% of our demand driver. So when you think about mobility, people moving buying homes, as Feerooz indicated, is a big piece of that. So as we've seen existing home sales slow from, I think the tops was, 6 or 6.5 million. Now it's down to, 4 million or just below on an annualized basis. That's a big difference. And when you look at the top of funnel demand for storage, and if mobility is 40% of that, as Feerooz indicated, that demand funnel has been reduced quite significantly. So there's a huge correlation between home sales, especially existing home sales, because that's what 75% of the pie. Huge correlation between existing home sales and demand for self storage. So we're all fighting for that reduced demand bucket, and it's certainly weighing on rates, which I'm sure we'll get to.
The supply demand imbalances in housing and is being talked about everywhere, especially here in California. And I guess with more people choosing to rent or to be in apartments or to be in homes but rent homes, is that changed that correlation quotient to storage absorption?
I mean, I think it's not as big a driver, because when you think about folks who are in apartments, most of them have limited amounts of goods that they're keeping around their house, or that they're trying to access, right? So I would say in some cases where we get a little bit of driver from apartments, it's more in the lifestyle category of demand, where people have mountain bikes or they have snow skis or other types of equipment, or hobby type stuff that they do, or that they use and have. But it's interesting. People in homes tend to accumulate a little bit more because they're generally in a different part of their life, right? So they're starting families and they have kids and whatnot. And it's not that folks don't have kids that are in apartments, but I would say that it's generally it having that the income from a household and someone who owns a house, it just seems like it's a much larger driver of stuff. That's what we've noticed. So we don't get excited, I guess, Robert, when we talk about like, oh, hey, if everybody just moves into an apartment, shouldn't that just drive up storage? We're not of that mindset.
Got it. So you don't see a tangible correlation to that. And I assume when they for rent a house, that's more correlated.
That's more correlated. We like that. So when you think about SFR rentals, that's our friend for self storage. Absolutely.
SFR, single family rentals, great, which is in its own right becoming a very significant institutional asset class. So I guess that is a benefit. Charles, just to stay on that, Feerooz hit a little bit of the outlook for 25. What signs of distress do you guys see with the 230 properties that you own or manage in storage right now? What worries you? What keeps you up at night?
Right. No, good question. I'd like to just maybe build upon what Feerooz had mentioned. He was talking about kind of what we're seeing in terms of headwinds in 25. I completely agree. I think 25 is going to be a little bit of a slog, very similar to 24, very muted results, both in transactions and operationally. I think one of the things I'd like to add to what Feerooz said is the supply side. So what we've seen on new deliveries have been escalated for a long time. You keep hearing that they're coming down, which they are coming down, but they're coming down from a very elevated level. So we're still getting deliveries, and it's something that we've kind of been tracking a little bit more closely since last September. We do a heat map over our portfolio every month, and what we have found out, I'll just give you like as of last September, and we think this number is coming down. We're about to kick out the next report for January, but we noticed in September that 87% of our same store stabilized portfolio has been hit with new supply. And the way that we define new supply is anything within a 5-mile radius. So that's pretty significant when you think about it. And we think it's coming down. Like those numbers were pretty consistent from September through December, but we think in January those numbers, we'll start seeing those come down a little bit. We think 87% might be the peak, just with the deliveries slowing down. But it is interesting how much activity we had around our portfolio. And again, we're in 20 states. Call it the Smile states, from the Northwest all the way to the Northeast, and a few states in between. But really, where the population is, that's where we've seen it.
Feerooz, as I'm hearing Charles talk about this oversupply or these new starts that need to be absorbed before we can get some stabilization and rent growth, if you will. You're predominantly owning these assets in California. So I think that might be the counter to what Charles is talking about in some regards. But give me positives and negatives to owning storage in California.
Yeah, I mean, we definitely own assets outside of the state, but I think Charles will probably agree with me here. We think California is one of the best self-storage investment markets in the country. And really, that stems from barriers to entry. If you look at existing self-storage supply and assets, number one, they rarely trade. And number two, it is significantly more difficult to build in California than other markets. That really stems from costs and then stringent zoning restrictions from a lot of these municipalities. And in turn, I think that really allows existing owners the benefit of outsized rent growth. And if you look at commercial real estate returns, rent growth compounded over long periods of time is significantly more impactful than any movements in interest rates and cap rates. So while you're battling a negative political environment, obviously California is not as business friendly as some of our neighboring states. We feel that the supply demand dynamics and a strong demographic base set California up to be pretty favorable investing landscape, especially from a self-storage standpoint.
And so further that you're doing pre-development and you're doing pre-development in California. So give us an example of something that you're pre-developing and why did you pursue it and what value add or what there must be a financial motivation to take on that added risk.
Yeah, and really from a development perspective, California is probably our primary target market. And we're doing everything from site selection, contract negotiations, design entitlements, working with consultants, contractors, sourcing financing, signing guarantees on debt. And obviously, this is all time intensive and a heavy lift. But we believe that we're able to develop to yield significantly higher than what we're seeing trades happen at on a cap rate basis in the marketplace, especially in these top tier coastal U.S. cities. We like that risk return profile.
So for his example that for us with specifics. So if you were to buy an existing stabilized asset today, let's be unlevered here for this conversation. What would the unlevered return be or the cap rate, if you will?
Yeah, I'd like to say, I mean, we're seeing things happen around 5%, but even well below that. And we're in the high fours in top coastal markets. And then I would say we're trying to develop in similar type markets to be north of an untrended unlevered yield on cost. So you're really building in kind of 200 basis points of development profit.
So if I heard you right, if something's finished and you're going to go buy it, you're buying it for a 5, but to build it from the ground up and take all that risk, you're going to stabilize that at a 7 and create that 200 basis point arbitrage, if you will.
Yeah, and to be clear, that's an untrended 7. So assuming today's market rents.
But now let's look at the glass as half full and talk a little bit about where do you see opportunity, Charles, in the sector?
I do think that when you kind of rewind a little bit and you look at what we went through in the pandemic, it was a very successful run there. A lot of people were looking to storage to alleviate rooms, a room that they needed to have an office in to remote work, as an example. So there was a good run for a couple of years, and we had some pricing power as it relates to rents. That all ended in August of 2022, and it's been, we've been fighting for that kind of reduced top of funnel demand that we talked about. But when you think about it, so since 22, we're what now, 2.5 years into kind of the struggle, I'll call it. We haven't given any of the gains back that we had from that big run up. As a matter of fact, we're still year over year on a positive basis for 23 and 24. So I would say that when you compare it to other product types, to have a run up like we did and to not give anything back is really good. I think the opportunity is going to come from the tidal wave of pent up demand that is sitting there for folks that want to move, right? I don't think we're going to have the tidal wave perhaps that I initially had thought a couple of years ago, but I do think that there's a capitulation occurring. More and more people are just going to make the move. They might downsize if they think that they wanted to move to a bigger house, but that's not going to happen. But they do want to move to a different area, wherever that is. I think that's going to start happening. So we'll start seeing that trickle through. And as that happens, we'll have, kind of a bottom or a floor in a rental rates, in asking rental rates. And I think with any luck from the REITs who, control a lot of market share, if they see that and they can push rates up, that'll help everybody because then we're not fighting on the existing rate side. So I think there's certainly a rental rate play that's ahead of us. I think, though, like I mentioned earlier, that 25 is still going to be a slog. So we're going to be working through this. There is some macro uncertainties that we're all dealing with as business owners and consumers, just with the political environment. So I think as that plays out and we get a little bit more of a firm footing under us, people will start making decisions and they'll start, the mobility pattern again. So with any luck, 26 will be off to the races, but certainly 27 and 28, I feel better about, assuming no big macro, issues arise. But I also think that the opportunity that we're seeing is also just, again, in the revenue management side. What we've noticed over the last 2.5 years, when we've kind of had this reduced amount of demand, we've gotten a lot more creative on the revenue management side. And I think it's going to play dividends as we pull out of the, this time frame. So I think once we have better footing on asking rates, we're still going to be able to push rates higher than what we had previously or historically been able to do.
Yeah, I'm going to come back to you on revenue management because of your background, and really that's a key role that you provide for firms like ours. So we'll talk about that. But Feerooz, I often have investors say, "Oh, have you thought about doing a development in this location? It would be perfect for storage." So talk a little bit about the diligence and the decision tree that you kind of go through as you're thinking about a new site selection for a new development project, which, as you've indicated, warrants a 200 basis point improvement to yield to take on that risk.
Yeah, unfortunately, I think we saw too many people move forward with those ideas over the last few years. But when we look for new development opportunities, we're really starting from a macro level. So we're analyzing things from a top-down approach, identifying where there's market rent strength that can first support new development in this cost environment. And then from there, we're looking at zoning feasibility, identifying where we think we can get a project approved, where it's allowed in certain municipalities. And then we dive into trade area specific supply and demand metrics, making sure that we're really not overbuilding a market, which is the biggest risk in self-storage. When you're opening a facility that has 800 to 1,000 vacant units, you need to be really sensitive to supply and demand. So at the end of the day, really our goal is to try and identify dense trade areas that have some barriers to entry. So when we get it done, we're not as worried about others coming in behind us. And or also we're looking for markets that are more high growth. You see a lot of new rooftops, residential demand drivers that will help support storage demand in the future.
So Feerooz, I'm going to make up a number here, but you'll help me. I'm going to say 90% of people that own storage or buy storage would never pre-develop it or develop it from the ground up. Is that overstated, or is that probably fair?
It's probably fair. 9 out of 10 mostly acquire. Developing is very difficult. I would say, again, more so here in California. The exact stats, I couldn't tell you. Charles might know better. But yeah, it's not a very easy and it's a very time-consuming process. I mean, we're talking 2 years to get a project through entitlements developed, and then another 3-year lease-up period and self-storage as you lease up at a loss of lease and burn off those discounts over time. So
I know you're building something right now in Upland. That's a infill market near Claremont. So to you, the greater risk is what? The construction risk than it is the lease-up risk, because of what is the predictability in your mind of its absorption given that dense market. But again, I don't want to put words in your mouth, but help us understand how you view now an out-of-the-ground development project.
yeah, so I'd say in California specifically, we are definitely more comfortable with the lease-up risk if we've done our homework right. So the entitlement and the construction are really the unknowns. And then as you move to more kind of cyclical markets like a Phoenix, I would say a lot of the risk then shifts over to the lease up, where you're more concerned about what your actual stabilized rate's going to be, how long it'll take you to get there.
Charles, I'm sure Feerooz is one of your easier clients, and he doesn't pester you, and he has no review process or requirements that he continues to put forth. But help us. What amazes me about the storage business, since we've got into it as an owner, is the sophistication of revenue management. of just how these properties are managed today?
Yeah, I mean, it's interesting because back in the day, I mean, we would just look around the market and see what everybody else was charging. This is 25 years ago, but we would just look around and see what people are charging. We would adjust street rates once a year, and then we would give everybody, some nominal increase, but it would be like everybody gets a 5% increase, and then we're done, and we move on to the next year, and it was real easy. Now we have. I think the latest that our revenue management team told me is we have 442 different classes of unit rental rates, meaning that we are taking it down to like the nth degree in terms of what our rental rate management looks like, our revenue management. So it's become very, very sophisticated. It's a lot like call it airline pricing today or hotel pricing. But even I would say even more so because we're dealing with the next issue, which is these tenants are not just booking a flight, but they're staying in your facility for up to 10 to 12 months. So it's really interesting to kind of see, what once you bring somebody in, what is the revenue management strategy for that tenant? So that has come significantly farther than I could have ever guessed. And we have I think where there's 5 people now in our revenue management team that all they're doing all day long is just playing with different, A/B type of strategies at facilities that are alike, but maybe in different geographies, trying to see what holds, what balances out our attrition rates. When people leave, where do we maximize the length of stay and the rental rate increases? So there's a lot going on behind the scenes for what's happening on pricing, and it's really interesting to see, and it's something that continues to evolve every day because obviously we're a 3-mile business. In a lot of markets, we have a lot of competitors, and so with the reduced top of funnel demand, you've had to be a little bit more creative in getting your disproportionate share of occupancy. And then once you get that disproportionate share of occupancy, what do you do with it? So that's really where the ticket is. That's where the metal, meets the road, or I guess the rubber meets the road.
So when the average person is looking to rent a unit, what's the process they go through?
So they inevitably almost entirely touch the online aspect of it, of the omni channel, if you will. They'll touch our website at some point in time. They'll look at pricing. They'll Google it, and they'll take a simple phrase like self storage near me. 5 or so will show up on a map. They'll look at pricing, and they'll start clicking around and seeing what happens. So it's basically through the web, through the internet is the initial contact. We have other channels, but I would say primarily it's through your organic ability to increase your search optimization, and then of course we supplement that with SEO or with marketing marketing dollars that we pay Google. So we'll use both. We'll use all channels. We'll use Yelp. We'll use Craigslist. There's really a bunch of different channels, but it all sends it right back into our website, and really Google kind of has they're like the central command, really. That's where you have to be really successful and really good.
So it sounds like AI is influencing already and will further influence the storage sector as a optimization and efficiency tool for owners and managers. Is that fair?
Yeah, we haven't really talked about that, but yeah, certainly. I think that's going to continue to play, more and more of a role as different ways to utilize AI come out. I'll give you a simple example of one way that we use it, which is kind of at the beginning of our process. A potential tenant may call into one of our facilities. A manager answers the phone. They have a conversation, and the tenant does not rent. Phone hangs up. We have a process that we listen to all the calls on an automated basis. We have a function that's allowing that process to learn from different calls and identify possible tenants who maybe would have rented had we taken a different stance on the phone call. And they identify those phrases, if you will. And then those phone calls are then kicked back to the district manager and the on-site manager to follow back up and to call that tenant back or potential tenant to come back for it. And we call those second chance rentals. And believe it or not, that ends up being about 5% of our rentals every month. So
Impressive. That's a good example. Feerooz, uh, if we walked into a brand new, let's take Chula Vista, brand new Buchanan storage, what what would a prospective tenant or an investor see that would surprise them and be indicative of the evolution of storage's property? I mean, that to me, if you drove by on the freeway, you'd think it was a hotel. I mean, or a Class A office building. I mean, just there. So there's the architectural element, but help us with that a little bit. What would they see?
Yeah, so I think when people think of storage, they might have this old vision of what we call a Gen 1 product. It's single story, drive up, barbed wire, ugly orange doors. And when you look at today's product, a lot of the stuff we're buying is newer Class A infill assets. As you've referenced, it may look like a hotel or office building. You go in into the leasing office, it's climate controlled, everything's nice. You have security monitors the background so you can see around the entire facility. Um, there's a lot of talk of unmanned facilities, but we're not there yet. You're greeted by a sales rep and the on-site manager in the leasing office, and then around the property you'll have keypad access controls into the property, gated entry, and then you'll have elevators to get you up to the multi-story upper levels, and then again climate controlled. So a lot of nice, safe, clean product that a lot of people don't typically think of when they think of self storage.
And do cities like storage?
Cities tend not to like storage, but I would say the sophisticated cities and planning departments are learning that we're a necessary evil in their eyes. And they don't like us really because there's no employment growth. There's typically 2 to 3 people on site, and there's no sales tax. So we're really just a warehouse for people's goods. But again, I think with especially here in California, all the dense housing that cities are trying to build, we supplement a lot of that really well. And if you look at consumer demand, people are continuing to learn how to use self-storage. So consumer demand is at an all-time high and is up and to the right on a graph. So I think people continue to utilize a product, find different ways to use it, especially as we're seeing multifamily and industrial rents continue to climb. We supplement people's lifestyles.
So maybe you both can answer this. I'll start with Feerooz. Um, the transaction activity and liquidity of the sector. It seems like it's held up, but has it held up over the last 24 months with the tightening of capital markets and the broader pullback in commercial real estate activities? How would you respond to that?
Yeah, so I think despite commercial real estate, the pullback we've seen and all the turmoil in the capital markets with the sharp rise in interest rates, I would say self storage has been quite resilient. I mean, we're not immune. We've definitely seen valuations pull back anywhere from 15 to 20%, like all of commercial real estate. But there definitely remains significant liquidity interested in investing in the space. I think a lot of these institutional firms still don't have their allocations of self storage within their greater real estate portfolios. And then I would also say that all the dry powder that we're seeing on the sidelines is really looking to shift away from the more volatile sectors like office and into the performing sectors, the niche asset types that Charles had mentioned earlier, where self storage is at the top of that list.
Right. Charles, any adds to that?
yeah, I mean, I think I would echo what Feerooz says. I think over the last couple of years, we've had some wounded investors either through redemptions, through core funds and other types of funds. Also, other holdings of assets like office, if you will, like that's really wounded some players. So I think there was certainly a pause even in storage, but I would say what I'm hearing is similar to what Feerooz is hearing, which is we are definitely more of an attractive asset class that people and investors want to put money into. And I would say that as these larger institutional investors come back to the table, want to invest money, we're going to be very, very high on their list as allocations pop back up and they get those sorted out, as Feerooz indicated. But I feel really good that we're going to have a lot of activity over the next couple of years. I do think, again, 25 might be a little bit muted as just kind of more the macro side of things kind of works its way out and the dust settles a bit and we understand things. But I know that folks are coming back, investors are calling, and they want to be active in the space. So that bodes well for existing asset holders who are looking to transact. What I think what we've seen over the last couple of years, more of the onesie twosies, like 1 to 2 to 3 asset transactions have been a little bit more active than the larger portfolios. And I think that's just that's just the capital markets that are kind of playing out right now. The REITs, their cost of capital is a little bit higher right now, so they're not as active in the larger portfolios. And I think as that loosens back up and REITs get their footing again, we'll see that turn around. And again, that's more of probably a 2026 phenomena.
So, Charles, how many clients do you have on the management side of the 230 units? I'm making up, let's say Buchanan owns 6 that you manage. So, there's a percent of some sort. So how many separate clients do you have?
I would say it's probably up to the 30 to 40 owner range, if you will. And that includes our investors that we joint venture with.
Sure. And what is the profile of most of those? And where I'm leading you is how is Buchanan, how is Feerooz, how do those assets kind of profile within your 230 as you might know them, not know them specifically, maybe you do, given your seat. But I'm just trying to get a sense for how Buchanan fits within that realm of customers.
Right. And so I would put them into 2 buckets. One is kind of a mom and pop owner, if you will, who maybe owned 1 or 2 of these. And then we have more of our institutional partners and owners who are trying to build out a portfolio of assets. Obviously, Buchanan Street's one of our most sophisticated investors, owners that's in the space. You guys are very knowledgeable about the space, and you're taking the risk at the right time, and you're also buying the right assets. When I look at your portfolio that we operate, it's high quality, Class A assets in really strong markets and great locations. So your guys' target for what I would say would be a Class A portfolio that's going to be very, very valuable at the end of the day. You guys are playing that out very nicely, and I think that bodes well, because I do think the newer vintage assets in those great locations in primary markets, think coastal California, those ones are going to be the most valuable at the end of the day. And we just look across our portfolio of the ones we own and that we've built and acquired, and our California portfolio is all coastal, and it's very, very valuable.
Yeah. Well, we certainly appreciate the relationship we have with your firm. I was at a JP Morgan alternative investment conference last week, and specifically they started talking about real estate and kind of the beachheads within real estate. And I was pleased to see that, like a lot of portfolio managers that are portfolio constructing, they need more storage. You can't just go push a button. You gotta bring it on proportionally. But clearly, it's not lost on them what now storage brings to bear within an investment portfolio within real estate. So again, you guys have been great. Feerooz, fun having you back. I think you were we've now done this for over 2 years, and you were an early podcaster with us, and we appreciate you coming back. We also, mobility demand drivers, low cap asset profile within the real estate portfolio, less volatility, stickier income stream, enhanced revenue management tools. We've learned a lot from you all today, and I know our investors appreciate it. And we're glad we have the relationship. So we would welcome you back on our Counting Capital podcast again, Charles. Thank you for participating. Keep up the good work, and hopefully Feerooz continues to get good value out of you and your team there. I want to thank you all for joining us on our Counting Capital podcast. I hope you had some good learning, and we'll look forward to having you on our next program. Thank you very much.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.